Well, let's get across everything that's going on in the housing market, including mortgage demand out there at the moment, given there's so many headlines about the housing bust and everything else in between. Anthony Landahl from Equilibria Finance joining us back on the show. Anthony, good to go and see you there. How have sentiment changed since we last had a chat on the program?
Yeah, g'day, David. Great to be here, mate. Look, sentiment's changed markedly. In fact, what we're seeing now is essentially a drop across all sectors of the market. We've got Adelaide and Perth and Darwin hanging in there, but the capital cities, Melbourne and Sydney particularly, they're down about 5% and 4.5% respectively since January in terms of their growth. We've got the regional markets as well significantly starting to see a fall in values. The perspective or the backdrop behind that is that obviously we saw it's on the back of large-scale growth, over 20% in Sydney, similar in Melbourne, and in the regionals, particularly those ones where they're commutable, a couple of hours from Sydney, places like the Southern Highlands, Geelong, Central Coast, areas like that, they had a 40 to 50% growth through that period. They're now also seeing values decline. So there has been a shift. May was a bit of an inflection point with the interest rate rises, and that's absolutely now starting to flow through into the numbers. Some economists are forecasting around about a 20% drop, which would take us back to July 2021 prices, just as a point in time in terms of how quickly it grew, and potentially over this period of time take us back to July 2021.
Anthony, give us a sense as to how inflation's impacting the housing market. We know that how the reaction function from the central banks. We know that interest rates have been rising and quite rapidly across various parts of the world, including here locally. Yeah. But of course, inflation is also impacting the cost to go and build a house. So existing buildings suddenly become more valuable in a sense. So how does that dichotomy go and play out, do you think, in this cycle?
It's really interesting. There's two elements to that. There's firstly the impact of inflation on demand, and that's essentially through cost of living pressures, and a lot of those cost of living pressures and inflationary pressures are non-discretionary expenses, fuel, building materials, groceries. So there's not a lot of wriggle room to manage those cost of living increases. Additionally, monetary policy is specifically targeting inflation. So what we're seeing is the cost of debt go up. That then flows through to housing demand, serviceability, how much people can afford. The other element that's interesting is the effect of housing on inflation and what's included in those inflationary numbers and the impact on inflation. And what we're seeing there, as you've hinted at, is what's included in the inflationary basket is not established dwellings, but new dwellings, essentially construction less the value of land. So the surge in construction materials, the cost of building, has had a big impact on inflation. The other area is rent. That's also included in the inflationary numbers. So we've seen a surge in rental. There's a supply issue in the rental market. Investors are down about 10% this year, which is very significant. And the only thing that's going to impact and help that surge in the rent is increased supply. And investors are sitting on the sidelines at the moment. There's a lot of uncertainty. So they're the two factors that are influencing inflationary numbers as well. The construction, which we've all seen, as well as the rental yields are growing for investors.
Yeah, vacancy rates around the country are so low. Here in Adelaide, there's every single night there seems to be a story about a rental crisis. I think I last saw a 1% vacancy rate. So very tight conditions, not just here, but across other capital cities and regional centres as well. Anthony, let's get the crystal ball out, mate, and try and go and see where do we think mortgage rates are going to go to in this particular cycle before we have to go and see the next easing cycle begin. What's your sense as to how things are looking right now?
Yeah. The crystal ball is pretty tough at the moment, but the general sentiment seems to be that we're going to see at least another 75 basis points this calendar year. That's going to take us to a cash rate of round about 2.6%. Some economists are thinking it'll go higher than that, up over 3%, but my intuition is that it's going to stabilise somewhere around 2.6 to 2.8% cash rate. Then we're probably going to see a little bit of steadiness in the market. We're already seeing some of the impact of the increase in interest rates flowing through in some of the retail numbers. So my sense is that we're probably going to start seeing another 50 basis points next month, then maybe another 25 basis points before the end of the year, with a little bit of steadiness into the new year, then maybe mid to late 23. We might even see a cut in the cash rate and rates coming back down a little bit. So I think the big thing that's mainly impacted people has been the rapidity. So I think the rise and then the drop in the housing values is going to be sort of pretty quick. And then I think maybe mid-23 we're going to start seeing some stability flow through to the market.
We know there's been an absolute flurry of refinancing activity across the mortgage market at this point in time. When it comes to the fixed side of the market, we know that swap rates have come off quite aggressively, and there has been some moves from some of the majors and regional names out there. What's the demand like when it comes to those fixed rates longer out the curve, like say 3, 4, 5 years?
Yeah, fixed rates bolted, as you said, 6-8 months ago. In fact, fixed rates moved before we even had move in the cash rate. They were moving last January. As you say, a couple of the majors, CBA, Westpac, they've actually brought their longer term fixed rates down. The main thing is variable rates are still 1.5%, 2% lower than a lot of fixed rates. So there's a lot of people looking at the fixed rates. There's a lot of uncertainty around the variable rates, but we're seeing a little bit of activity mainly around people coming off a fixed rate. They might be coming off a rate under 2%, or in 3 or 6 months, they might be coming off a rate under 2% in and around the 4 to 4.5% mark. That's where we're seeing people really look for new opportunities. Those seeking some certainty over 3 or 4 years, we're seeing some activity there with fixing, but the main area is people looking at their opportunities now that their fixed rates are coming off. They might have gone to a particular provider for a certain reason because it was a good fixed rate at the time. They're out looking at the marketplace, both fixed and variable.
And just to be clear, competition is still pretty intense out there at the moment, so there is an opportunity for people who have to renegotiate to go and get a relatively good deal.
Competition is red hot on a number of fronts. It's incredibly competitive market. So what we're doing with our clients is if someone's looking around or we're renegotiating rates, we'll go to their current provider, and the current providers are coming to the party in a lot of the cases at the moment with their variable rates. Fixed rates are pretty well set and forget. The providers have moved them. But as you say, some of those longer term fixed rates are starting to come back to the market a little bit as well, which is attracting some attention, particularly with CBA and Westpac now in under the 5% mark on their 4-year fixed rates. That's attracting some people as well. But yeah, she's red hot out there in terms of some of those providers, particularly some of the second tier providers who still have some of the cheaper funds that they can take to the marketplace as well.
Anthony, good reminder there to go. Don't be complacent when it comes to your mortgage out there. If you go and shop around, you can find yourself a better deal and save yourself thousands. Thanks for joining us here on the program. We'll speak soon.
No worries. Thank you.